Now this talks about a trend that fails, Rule 16 is a trend that fails to achieve fulfillment in time may still reach the target in price and vice versa. Now I mentioned this before. You can't always have time and price exactly equal on both of them. What will happen is on any given day the two legs will be comparable in time but not price perhaps. Or they'll be comparable in price but not time. And there's a case where you have to make a decision that I'm going to get out in terms of time. If I get that 10-minute rally that we had on the first leg, I'm going to take profits at that point regardless of where the price is. Or if I get that 3-point rally that we had on the first leg, I'm going to take profits regardless of how long it takes to get there. So it may take 10 minutes on the first leg and 5 on the next. The other inference to draw from this is when it fails and you're looking at it and you're in the position perhaps and you're saying there's something wrong here, what do I do? If it fails in both time and price, then you usually have to get out because it means it's going to go the other way. And you often see this at reversals. For instance, you get a 400-point break. You're not in the market. You do the calculations. You know where the 618 is right away. It bounces up. It starts to consolidate, goes sideways, an equilibrium is formed. And at that point, now you have a target on the downside, both in time and in price. Now it's just a question of it reaching that target. So it starts to break out to the downside. It goes to new low ground. Everything's going the way it should. And all of a sudden it stops. And you're looking at it thinking, gee, time's passing. It's stopped. It hasn't gone to where it should go. What's going on here? Usually what's going on is it's about to reverse and it's not gonna work. And if you're alert to the situation, you can capitalize on it by getting out quickly and going the other way. And there are other things which we haven't talked about yet, which are the confirming indicators, such as a divergence in the slow stochastics, which can help tell you that it's not going to move any lower. And in this section here, we're going to talk about that when time and price are unequal. On page 93, I've mentioned that when time and price are unequal. The second leg may fulfill the pattern on time but not on price, or the second leg may fulfill the pattern on price but not on time. If both time and price fail, look for a reversal. Very important rules, so pay attention to that. Now in 94, what I've done is I've printed out a chart showing you one leg but not the second. So the first leg is 380 on the points, 23 minutes on the time, and then we have an equilibrium. At that point, I take the time and price, I add the equilibrium to the first leg, and I get a target sell. And I'm also looking ahead in terms of the low when it breaks out to see if we get 23 minutes. The target price, which is on 95, is 980.10, and you can see the first leg, the 23-minute rally. You can see the pullback. You can see the equilibrium, which is between 76 and 76.5. It's on page 95, and then you can see the run up from there. The second leg got there in terms of price, but it took 5 more minutes to get there. The target was 980.10, and it went to 980, it looks like 40, but it took 28 minutes instead of 23 minutes. So here's a case where at 23 minutes, you still hadn't gotten there in terms of the target price. If you held on, you got it. And once it went there, of course, then it was ready to go the other way. On 96, you have a more difficult trade because it spends more time coming down prior to going up to the top. So you have a leg of 430, and it took only 5 minutes to get there. But then look what happens. It goes down, it goes up, it goes down, it goes up, it goes down, 3 times down, making new lows. It violates the 618 several times. 1, 2, 3, 4, 5, 6, 7, 8, 9 minutes total. And only then does it start the second leg. Now it goes up for 9 minutes, and it doesn't get up to the target. It sells off. It makes one more shot at the top, which I call here stop running, because remember, if there's a high up there and it's going up again, they'll get that high, even if it's coming down. And of course, they did get it. So that one failed both in time and price, because in 5 minutes it couldn't go 430. There was a 9-minute rally, but it wasn't large enough to get where it should have gone. Rule 17, a second leg that fails suggests a reversal. When a market cannot complete a symmetrical two-tiered trend, chances are the move is over. You must reverse direction should the second leg fail. This failure swing is characterized by a market that trades back into the consolidation area or violates the 618. And this brings up another important point, which is, if you have a rally and you have the consolidation period and it breaks out to form the second leg of that rally and comes back down into the consolidation, it's no good, because it's not behaving the way it's supposed to. There should be a leg, a consolidation, and a leg. You don't want to have it go and break out and come back. And you'll see this frequently in markets that aren't going in that direction, but the other way. They'll fake out everybody by seeming to go into new high ground momentarily, only to go the other way. And this, by the way, is why it's so hard to beat the S&P market or the futures market in general, because there's a lot of false breakouts. But if you know what to look for and how it should behave versus the way it does behave, then you'll have something to work with. And that's the kind of thing that I'm looking at when I'm trading. I'm trying to concentrate. I'm looking at every tick. How is it going up? Does it stay up there? They knock it down right away? Because once it goes, it should go. And if it fails, there's no future in hanging on to that. You need to get out. Here on page 98, we have a failed second leg. We had a sharp rally, a pullback. The second rally goes into new high ground, and it fails. And there's a confirmation on this one, too, because if you look at the bottom of page 98, in here you'll see that the slow stochastics, the second rally up, failed. In other words, you have a divergence when the prices and the stochastics are out of line with one another, when they diverge. What should happen is prices should go higher and stochastics, slow stochastics at least, should go higher. What you had here was prices go to new highs, stochastics fail to go to new highs. That's the reversal. And that, by the way, is the way I use stochastics, only as a confirmation tool in terms of divergences. On 99, we have where's this market going? We have a first leg, 11-minute rally, 340, and it goes up there, and then it goes into an equilibrium. The second leg then begins, but it can't get to the target sell price. Not only can't it get to the target sell price, but there's a divergence on the bottom here where the prices go to new high ground, but the stochastics can't. And that's a sign that it's not going to work. And this is a prime example of it not working. So you can't expect, it's asking too much really, you can't expect the market to do this for time and price to work every single time. So what we're getting here is a pattern where it actually fails. One of the troubles with tracking a market like this is, as the divergence occurs, you can't really see it on the chart until it's over. So it's easy to go back after it happens and say, of course, there was a divergence there. It's difficult in the heat of battle when you're trading it, and indeed you're long here in the consolidation because you want a comparable a leg. It's difficult to see. But I'll tell you, because you're long, because the market's running out of steam, you're going to know pretty soon afterwards that it's not working, because as soon as it sells off here, it's no good anymore. You notice on the first leg there was no sell-off. It went up, 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 right to the top. Then there was a sell-off. But here, it goes up, 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 and it stalls out before it gets to where it should have gone. So that's how you know when it fails. And here is an illustration of that on page 100. The second leg fails and the market declines. But even here, look at the symmetry as it comes down. What you have here are prior lows, and always look at prior intraday highs and lows. You have a double top up here, you have lows here, and it starts to sell off. Well, as it sells off, it takes out these stops, it takes out these stops, and only then does it bounce up.